Hello and welcome to Price Action Defined. My name is Brian Kahn. You have my email there. You have the IBFX collaborator page, as I call it, where different analysts post their commentary, dailyforextradingedge.com, where I post about 4 days a week. And then you also have my website, jupiterpeakfinancial.com, if you have any questions about specifically what I do and to see all of the commentary that I do provide on a regular basis. Before we get into things, as always, your questions are appreciated, and you can type those into the questions field as they pop up. Always remember that questions help me to cover other topics that might be important to you as I go through the material. Here's a quick disclaimer, and I'll leave that up for just a few seconds. And the volatile markets disclaimer: in volatile or fast-moving market conditions, stop and conditional orders become market orders to be filled at the prevailing price, which may be vastly different from the desired price. Stop loss or conditional orders do not always guarantee a fill, and such orders may not be filled as placed, and substantial losses may still occur. The outline of where we're going this evening: quick catch-up on fundamental analysis, technical analysis, intermarket relationships. I'll touch on those, and then we'll get into the main subject tonight, which is technical analysis and price action defined. We'll talk about the drivers of price action, and then a couple slides on the detailed action within those price movements and what you're looking for, and some examples in the markets, including intermarket relationships. And then I'll do a quick review and questions and links that will help you as far as resources go. So fundamental analysis, the importance of fundamental analysis. I actually was on a panel today for the state as far as a collaboration between American consulate and foreign consulates, and as far as international commerce. And I really hammered the discussion of current fundamental events, and those fundamental events are being looked at very closely and monitored very closely by central banks, because central banks are really a key driver of price action right now. And the fundamentals that they're looking at, we need to key in on what could cause a change in central bank projections as far as interest rates, whether they're more accommodative or less accommodative. So I cannot stress the importance of fundamental analysis enough, and what I mean by that would be the big macro data, which is the central banks and their intentions with interest rate policies. Your broker provides you great analysis. I already mentioned dailyforextradingedge.com, so take advantage of your broker, whether it's questions about the platform, questions about how to use technical analysis tools, or obviously staying on top of fundamentals. You can also do it through a calendar that IBFX does link to, forexfactory.com. It's a great free educational tool with lots of great information on it. And again, staying on top of all of the central bank information as far as when they're speaking, as far as interest rate decisions are concerned. You obviously have TV stations like CNBC and Bloomberg and other market sites that are important for you. Technical analysis, again, the main subject tonight will be technical analysis, but this slide I always put in because I think it's very important. You've got to understand the trends. Which way is the trend going, up or down? Support, where are their buyers? Resistance, where are their sellers? Intermarket relationships. Can you find an edge based on one other market, whether it's the commodity market, whether it's equity markets, whether it's bond markets, and how does that help you with this market you're trading, the Forex markets? What are you finding that's giving you a trading edge? That's what successful traders have, is an edge, and you need to make sure that you're using your different market analysis in your daily routine to give you a trading edge. All right, so again, questions are welcome at any time. So let's get into the main subject tonight: price action defined. Again, I'm stressing fundamental drivers. This is key. Central banks and governments and geopolitical decisions can affect market direction very quickly and very drastically. That's that volatile markets disclaimer that I read off earlier. At the snap of a finger, the central banks could change their mind and change policy. The most recent to change their policy, which was a surprise, was the Australian dollar. The Royal Bank of Australia, they went ahead, and the Reserve Bank of Australia, they went ahead and did lower their discount rate, lower their interest rates from 3.0 to 2.75, which was a surprise. They were saying high interest rates were hurting their exports. They weren't as competitive as other regions of the world that had lower interest rates. So you've got to pay attention because that was a big, big driver of price action in the Australian dollar against other currencies. So it is key to stay on top of the sport of your economic calendar and when central banks are talking. But again, there's no guarantees when central banks talk. They could have surprises, hence the volatile markets disclaimer. I can't stress that enough. Technical drivers, there are technical patterns, there are technical indicators, moving averages and stochastics and moving average convergence divergence indicators and things like that. Right now, I think, and just the simplest ones are support and resistance, as I talked about in a couple slides ago. Those are taking a back seat, though, to the fundamental drivers. So even though we're going to focus on technical analysis today in the technical drivers, we still have to be aware of the big fundamental drivers that are kind of overarching everything else. So we combine the two of these to create trading plans. Sound trading plans with predefined risk to reward, knowing that there aren't any guarantees, but we're doing the best we can with proper account management and risk management for each specific trade. All right, so now we're going to get into sequence, targets, and failures. So the sequence, I'm looking for a sequence of higher highs and higher lows. That makes an uptrend. I'm looking for a sequence of lower lows and lower highs. That makes a downtrend. Then I have targets. For a uptrend or downtrend to continue, I need a higher high to be taken out, and that would continue the uptrend. So the previous high in an uptrend, I need a higher high to be made to keep that uptrend going. Or if it's a downtrend, I need the low previously to be taken out and a new low is set, and then we have a new continuation of that trend. When those targets aren't taken out, we have failures, and when we have those failures where it fails to reach that target, that could lead to a change in sequence. So the easiest thing to do right now to see a uptrend as far as sequence goes is to look at equity markets around the world. So I'm going to just pause here and I'm going to change the program, and I'm going to bring up the sister company to IBFX. I'm going to bring up the TradeStation platform first. Then I'm going to bring up the SPY, which is just a broad index in the United States. The S&P 500 is the ETF that represents that S&P 500. And here's what I'm talking about with uptrends, okay? Here's a low. The low is higher, higher low, higher low. So really, what we're seeing is the lows are getting higher, and then we see the highs getting higher as well. So if we go ahead and do a quick drawing here to connect the highs, roughly, we could do something like this. Oops. Let me click again. All right. Drawing and trend line. Okay. So there's my highs that are getting higher successively. A high up here, highs up here, and then we dip, new highs. We dip down, we make a new high. We dip down, we make a new high. So for this trend to continue, I need to get above this point right here. I need to make a higher high here, okay? So at some point, it might be tomorrow, but at some point we're going to set back. And as long as the low is higher than this low right here, as long as the low is here or here or here, eventually I need the trend to turn around and make a new high and go up. So what we've had is a series of big moves up, small moves down, big move up, small move down, big move up, small move down. So each time it's gone 3 steps up, 1 step down, 3 steps up, 1 step down, 3 steps up, 1 step down. At some point, something fundamentally or technically will come in, most likely fundamentally, and we'll have a bigger retracement. We'll have 3 steps up and 3 steps down. And eventually, it'll be too much, and we won't be able to make a higher high, and that's where we'll have a failure. The high won't be reached. We'll set a lower high, and again, when the targets aren't reached and there's a failure, that could lead to a change in sequence where now we're looking actually for lower lows and lower highs. So as far as we're concerned right now, higher highs and higher lows. So really, I'd be concerned with this low right here, okay? This price point right here around 153-ish. If that gets taken out, by the time we get down below 153 and down, I have a feeling that it'll be too hard for us to go 150, 153, 155, 160, 165, 170 and make a new high. So the more you retrace, the more likely you have of an ensuing failure. All right, but we don't have that failure yet. We don't have that lower low or lower high yet. We have higher highs and higher lows. So I just wanted to show you what a sequence looks like when you have a trend intact and what we're looking for that trend to change. So if you are a trader and you say it's too high, you better have good reasons why, because every time it's been too high, it sits back a little bit, but then it makes a new high right away, okay, a day later, a couple weeks later, whatever it may be. So if you're going against the trend, you better be perfect in your location. Maybe you use the trend line to short, but you've got to realize that it doesn't go down much, and you've got to take your profits because a couple days later, a couple weeks later, boom, it makes a new high, and the trend line extends itself higher. So you've got to remember which way is the flow. Obviously, if you're buying dips, you're getting a better ride out of this than if you're going ahead and selling it and hoping that it goes down. This is a trend based on fundamentals, which is based on central banks intervening and causing accommodative monetary policy to be very bullish for the worldwide equity markets. All right, so let's go ahead and now move into foreign currency markets and take a look, because what I want to do here with the slides is I want to show you examples. As I go to the next slide here, I want to show you examples, long-term examples in Forex. I already showed you a pretty long-term example in the S&P, but in the equity markets, I want to show you a long-term example in the Forex markets using price action and short-term examples using price action. And one of the intermarket relationships I like, again, what market helps me trade the market that I'm trading? So do I use the equity markets or commodity markets to help me with the Forex markets? So I want to look at the U.S., Canadian, and oil prices. So we'll flip back and forth between that. So let's jump into, before we get into the U.S., Canadian oil prices, let's move in the relationship there. Let's switch over to the IBFX MetaTrader 4 platform. And let's see. Well, we had recent news out of the Australian US dollar, okay, as far as their interest rates being weakened. All right. So here's a daily chart. Unlike the S&P 500, the equity market's trending up. You have, over the past year, basically, you have a very sideways market. If we look at starting back here, roughly, July of 2012, so almost 12 months, we've been in a range. So remember, I asked you, which way is the money flowing? Is there a trend? And also support and resistance. Well, right now, if you look at this horizontal line going right across here, you're looking at my cursor going right across here, right around 101.80. You're looking at support, 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 support. So every time it's come down there in the past, it's bounced up. But you have to ask yourself, here we are now, but what's gotten us here is, oh my goodness, the Royal Bank of Australia, we just lowered interest rates surprisingly. That's not good for the Australian dollar, especially if the U.S. comes out and says, hey, we're going to raise interest rates. Well, that would be a double bearish event probably for the Australian dollar, because U.S. is getting stronger as far as their dollar, and the Aussie is getting weaker. So it's holding in here right now off that support, but you have to ask yourself, are you a buyer down here based on this announcement that just came out? Maybe that announcement, this is just a quick dead cat bounce or something like that, and we're going to head back down. So as far as the sequence goes, if I bring you in a little bit here, as far as the sequence as of late, again, here's the top of the range, resistance, 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 resistance. For a year, you guys, we've gone basically between 101.80 and the bottom, and we've gone up to 105.80 on the top. So we've been in about a 4 penny range, 400 pips for almost a year now. All right, so now we're going to look at that down move off of that high at 105.80. We had a big move down, then we had a small retracement, another big move down, a new low. Again, the highs are getting lower. There's a high, there's a high, there's a high. A little bit of sideways action here, so this pattern got exhausted here, and we had higher lows and higher highs overall, in this area. But overall, the trend has been down, so you might have done a Fibonacci retracement or use moving averages or use fundamentals, whatever it may be. So in the big trend, there's a high, and now we might be setting a high here and seeing if we roll over. So I could probably take these other tools off, I'm going to delete, and I'm going to delete, and now I'm going to draw my trend line connecting these highs, okay, something like that, all right? So maybe you're waiting for it to come back up here and use this trend line as resistance like it has in the past, because you're fundamentally bearish the Australian dollar because of their announcement, and you're looking to sell it in good locations fundamentally, and then you wait technically. You line it up with moving averages, you line it up with trend lines, you line it up with Fibonacci retracements, whatever it may be. So overall, the trend is down. Keep in mind, we're at the very bottom of that range. We're sitting on major support down in the 101.80 area, and we bounced so far. But fundamentally, are you still a seller and you're licking your chops when it comes up here and says, I'm looking to sell? No guarantees. Royal Bank of Australia might change their mind and say, we're strengthening our dollar. We made a mistake. That's that volatile markets disclaimer. There are no guarantees. You've got to trade the right account, the right amount of contracts, and risk the right amount of pips depending on how many contracts you're doing, depending on your trade time length and depending on your account size. Are you a swing trader? Are you a long-term trader? Position trader? Depends on who you are. That's what I work on at Jupiter Peak, getting people to risk the right amount of pips given who they are as an individual trader and their trading personality and account size and time available in front of the markets each day and what time zone they're trading and what pairs they should be trading. If you don't know that stuff, then you might want to think about it. And again, you can refer as far as some of that information at jupiterpeakfinancial.com. But again, looking at the Aussie dollar, the question now is, are we going to set a lower low? Here's a low. Here's a low. For the downtrend to continue and violate that major support area, we're going to have to make a lower low if that's the case. Where do you want to get short? Do you want to get short up high and hope it runs down to that low? Do you want to get short as it breaks that support and that's your momentum trade? Lots and lots of questions to be asked about the long term and obviously the short term in the Aussie dollar. Okay, we're going to go look at another pair here. Like I said, the U.S. dollar and the Canadian dollar, another commodity currency, if you will. So as of late, and I'm going to flip here to a chart of USO, which is an ETF that tracks oil prices. As of late, just over the past month or so, equity prices have done well, and the price of oil has gone up. Here's the price of USO, which tracks oil prices. It's gone 31, 32, 33, 34. So a $3 move of a $31 entity is 10%. That's a big move in about a month. Is there any relationship between the U.S. dollar, Canadian dollar? So the U.S. dollar, which doesn't export lots of oil, well, it's starting to export more commodities. It might be a net exporter, but obviously Canada exports a lot more. So if we look at the daily chart over the past month, the U.S. dollar against the Canadian dollar, the U.S. dollar has dropped. Oil prices have gone up. The U.S. dollar has gone down. So that might be a little bit of a relationship there, maybe a supply and demand. The better the equity markets go, the better the economy is going, the more jobs there are, the more people flying around the country. We've seen that in jobless reports getting less and less and less. The unemployment picture picking up in the U.S. better than expected. For the most part, good revisions to past employment numbers over the past 60 to 90 days. So we're seeing oil prices go up, the U.S. dollar go down. Again, you still have to work on the intricacies of what's going on in the central bank for the Royal Bank of Canada there, in their central bank, and then the central banks here in the U.S. So we have to monitor that language. But overall, we've had, as of late, a downtrend. So let's hone in on this downtrend. Again, a big move down, a small move up, another big move down. So now your question is, if you're bearish based on fundamentals, technicals, do you want to get short the Canadian here, or was it better to get short as it went down, retraced back up, and then started to move down again? Has the train already left the station? Are you going to wait for another retracement and then try and get short the U.S. dollar against the Canadian when the U.S. dollar pops up a little bit? So again, not so much on the long term, all right, going back to not a long term in any one direction, because as the past year shows, pretty sideways, all right? We've had some downtrends and some uptrends, so definitely not a trend in one direction here. But as of late, if you're a shorter term trader, you do have some price action helping you out. Big down move, small up move, big down move, small up move, big down move, small up move, big down move, small up move. At some point, this is going to get exhausted, and you're going to have a double bottom, you're going to have a higher low, and you might be able to be a buyer of the US dollar Canadian. Is it going to be a double bottom here? Is there going to be a bullish divergence using your MACD or your stochastics or some other tool that you use? That's the technical analysis that you're trying to combine with the fundamental analysis. Why can I be a buyer down here when the trend is going down? Where can I do it safely? Where can I build in risk reward? Where can I have good trading parameters? All right. So again, it's all about building a trading plan. Let's look at the pound US dollar because we did have a trend as of late. A huge, monstrous downtrend from up here, 1.58 or so, 1 point above that, 1 point in the low 60s, all the way down to 1.48, so about 13 or 14 pennies. And now if we retrace back up, what's caused this to go back up? Is it because they're starting to think about more easing in England versus the U.S. because the U.S. has already eased so much, whatever it may be? But the question is, the pound has started to come back up. Here's your big down move. As a long-term trader, here's your up move. Is this a place where you can start to sell the pound based on a Fibonacci number, based on fundamentals, based on some other technicals? So the short term, over the past couple months, has been up, but long term, it's a big move down. And now the question is, are we in a big range and we're just going to cycle back and forth, back up to the high, or is there a reason for us to trend? So if you're looking longer term, then you start to see, hey, this might make sense. We're actually in a big range. Going back to 2010, so basically 3 years, we've been kind of in the 148 to 162 range, 13 or 14 pips from top to bottom. So maybe there isn't a reason to trend, and that's what I want to finish up with. That's what I spoke about today. If you're a big business and like Walmart and you hedge your labor costs and your fuel costs all around the world, or you're an individual trader like me and like you, and you're just trying to speculate off short-term movements, how can you be convinced that we're going to trend in one direction when the central bank can step in at any time and change the direction very drastically? So be very, very aware of the fundamental analysis that's driving the central banks to make decisions, and make sure you're aware of those central banks when they're talking and what they say, because they can drive price action in one direction for a long time, and that's a trend that we could hopefully catch on to and understand why based on good fundamental analysis. So I hope that that was helpful for you to see some price action defined long-term and short-term on a few pairs. And just to wrap up with the slides, all right, so long-term examples, short-term examples, we looked at a couple intermarket relationships because, again, I showed you oil prices and then what the U.S.-Canadian dollar is doing in turn. Again, may not be totally related, but there's still more to weigh as far as what are the central banks doing. But I think there's something to be said there, driving a commodity-driven currency and deriving some of that price action from the actual commodity itself. So to review fundamental events, I've keyed in on paying attention to central banks. Technical analysis, trend, support, resistance. The Aussie dollar gave us a good look at support and resistance. Price action defined, keeping on top of the fundamental drivers, and then looking at technicals and the examples of those, and paying attention to sequence. Higher highs and higher lows make an uptrend, lower highs and lower lows make a downtrend. Targets, the lowest low or the highest high have to be taken out for that trend to continue. And if not, then we have failures like double bottoms and bullish divergences or bearish divergences. And that leaves us with the last slide, which takes us to questions and resources. So again, I'll be talking to you about 2 weeks. I talk every 2 weeks or so, so I hope that you'll join me in 2 weeks for a fundamental analysis update, a technical analysis update, and the main topic to be determined. If you want to see these recordings and get them, you can always email me. You can also go to the IBFX education pages and go to Daily Forex Trading Edge for my daily market commentary, to the YouTube page for IBFX videos, and then again, you can always go to my website, Jupiter Peak Financial, for all of those links. So thank you very much for your attendance, and I look forward to seeing you in 2 weeks. And again, pay attention, please, to my daily market commentary every day at dailyforextradingedge.com or jupiterpeakfinancial.com. Thank you very much, and happy trading, and invest intelligently.